The year you retire is the most dangerous year of your financial life. Not because the market might drop, not because inflation might spike, because in the year you retire, you go from a system that managed your money automatically, withholding taxes, depositing contributions, tracking deadlines, to a system where every single decision is yours. And most people step into that system with a set of assumptions about how their IRA works that are either partially wrong, completely wrong, or were true last year and are no longer true today. I have watched new retirees make the same 5 mistakes, sometimes all 5 in the same tax year, and lose money they worked decades to protect. Not to bad investments, not to fraud, to rules they did not know existed. The first 4 mistakes are expensive. They create tax bills, underpayment penalties, and missed optimization opportunities that cost real money every single year. The 5th mistake is different. The 5th mistake triggers a federal penalty under the Internal Revenue Code. There is no warning, there is no grace period. The IRS cannot waive it. The IRS does not have the legal authority to waive it. If you make this mistake, the consequences are permanent. I know people who have lost tens of thousands of dollars in retirement savings to this one rule. And the worst part is, they were trying to do the right thing. Today, I am going to walk you through all 5, in order, from most common to most severe. By the end of this video, you will know exactly what to watch for in your own situation and exactly what to do differently. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making decisions about your specific situation. My name is Kevin, and every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. Let's get into it. The first mistake is so common it is practically a rite of passage for new retirees. Here is what happens. When you reach retirement and start taking distributions from your traditional IRA, your broker or custodian will ask you what percentage you want withheld for federal income taxes. The default, the option that is pre-selected if you do not actively choose something else, is 10%. Most new retirees see 10% and think, that sounds about right. They accept it, they move on. And then April arrives, and they owe thousands of dollars they do not have sitting in their checking account. Here is why 10% is almost never the right number. Your traditional IRA withdrawal is taxed as ordinary income. It gets stacked on top of every other dollar of income you have: Social Security, pension, dividends, capital gains. Together, that combined income determines your actual tax bracket. If your combined retirement income puts you in the 22% bracket and you are only withholding 10% from your IRA, you are 12 percentage points short on every single distribution. On a $30,000 annual withdrawal, that is $3,600 in taxes you are not paying throughout the year. The IRS will bill you for that $3,600 in April, and if the shortfall is large enough, specifically if you underpay by more than $1,000 after accounting for all your withholding, the IRS will also charge you an underpayment penalty on top of the tax itself. According to IRS data, 14 million Americans were penalized for underpaying estimated taxes in 2003 alone. That number has grown every year, and retirees are among the fastest growing segment of that 14 million. The fix is straightforward. When you set up your IRA withdrawals, withhold at your actual marginal tax rate, the rate that applies to the last dollar of your projected income for the year, if you are in the 22% bracket. Withhold 22%. If you are in the 12% bracket, withhold 12%. If you are not sure which bracket you are in, withhold 20%. And you will almost certainly be over rather than under. You can adjust withholding on every distribution. You are not locked in. If you have been accepting the 10% default and you are approaching the end of the year, you can take one additional distribution before December 31st and withhold 100% of it. The IRS treats withholding as paid evenly throughout the year, regardless of when it was actually withheld, which means a December correction can eliminate an underpayment penalty for the entire year. That trick alone is worth thousands of dollars to retirees who discover it in November instead of in April. The second mistake is the opposite of what most people expect. It is not withdrawing too little. It is withdrawing too much, in the wrong way, at the wrong time. Here is how it happens. A new retiree, let's call her Donna, is 66 years old. She has a pension of $22,000, Social Security of $18,000, and a traditional IRA worth $340,000. She needs $45,000 a year to cover her living expenses. Her pension and Social Security cover $40,000. She needs $5,000 from her IRA. Then the furnace dies, or the car needs $8,000 in repairs, or there is a medical bill. She calls her broker and says, I need $25,000 from my IRA right now. Here is what she does not realize. That $25,000 withdrawal does not just get taxed at a flat rate. It stacks on top of her other income, and as her total income climbs, multiple things happen simultaneously. Her pension is fully taxable. Her Social Security, which was previously 50% taxable, now crosses into the 85% taxable tier as her income rises. The $25,000 withdrawal itself gets taxed at a higher effective rate because it is pulling more of her Social Security into taxable territory. This is the Social Security tax torpedo we covered in a previous video, but the mechanism works the same way from the IRA direction. Every extra dollar of IRA income can trigger 85 cents of additional Social Security taxation on top of its own tax. Donna's effective tax rate on that $25,000 emergency withdrawal is not 12% or 22%. It could be 40% or higher when you account for the cascade. The fix is not to never touch the IRA. It is to understand the cascade before you touch it. Know where your income sits relative to the Social Security tax thresholds, $25,000 single, $32,000 married, before you take any large withdrawal. If you are already above the 85% tier, a big withdrawal costs you only its own tax rate. If you are in the middle tier or approaching it, a large withdrawal can be extraordinarily expensive. Break large withdrawals into multiple tax years when possible. Take $12,000 this December. Take $13,000 in January. Same $25,000. Completely different tax impact because it is split across 2 calendar years. This sounds like something only sophisticated investors would think about, but it is a calculation any retiree can do in 20 minutes with a pencil and a tax bracket table. The third mistake catches more retirees than any other. And it catches them completely by surprise because they are doing something that feels completely routine and entirely harmless. They want to move their IRA from one bank to another. Maybe they found better rates at a new institution. Maybe they want to consolidate accounts. Maybe they are moving to a new state and want a local bank. So they call their current broker, close the IRA, and receive a check. That check is now a distribution. The clock started the moment that check was issued, and they have exactly 60 calendar days to deposit the full amount, into a new IRA account. Not 61 days, not 63 days, 60 days. Miss that deadline by even one day, and the entire amount becomes taxable income for the year, at their marginal rate, with potential penalties if they are under 59.5. On a $200,000 IRA, missing the 60-day window by a single day can create a $44,000 to $50,000 tax bill in a single year. This is called an indirect rollover, and it sounds simple enough. Receive the money, put it in the new account within 60 days. But there are 2 things that catch people constantly. First, the clock is 60 calendar days, not business days. Weekends count, federal holidays count. If you received the check on January 1st, your deadline is March 2nd. Second, if you ask your current broker to send you the IRA funds directly, they are required to withhold 20% for federal taxes on employer plan distributions. Though for IRAs specifically, the default withholding is 10% unless you opt out. Either way, if any amount is withheld and you want to roll over the full balance, you have to come up with the withheld portion out of your own pocket to deposit the complete amount. If you only deposit what you received after withholding, the withheld portion is treated as a distribution. Example, You have a $100,000 IRA. You request a check. Your broker withholds $10,000. You receive $90,000. You deposit $90,000 in your new IRA within 60 days. The IRS sees a $10,000 distribution, the amount that was withheld and not replaced. You owe income tax on that $10,000. The solution is simple and eliminates all of this risk entirely. Never take physical possession of the money. Use a direct trustee-to-trustee transfer instead of an indirect rollover. You instruct your current IRA custodian to transfer the funds directly to your new IRA custodian. The money moves institution to institution. You never touch it. There is no withholding. There is no 60-day clock. There are no limits on how many times you can do this in a year. Every time you want to move an IRA, use a direct transfer, not a rollover. A transfer, this is the single most important sentence in this entire video for the retiree who is planning to consolidate accounts or switch institutions. Direct transfer, never take the check. This is the mistake that costs people the most money for the least reason, and it connects directly to mistake 3. Here is the rule. You are only allowed to do one IRA to IR indirect rollover per 12-month period across all of your IRAs combined. Not one per account, one total. If you use an indirect rollover to move money from IRA number 1 in March, you cannot use another indirect rollover to move money from IRA number 2 in August. If you do, that second rollover does not count. The money that was supposed to be rolled over is treated as a taxable distribution, and there is no way to fix it. Notice that I said 12-month period, not calendar year. It is a rolling 365-day period from the date of the first distribution, not January 1st to December 31st. The day you take the first distribution, that date plus 365 days is the window. This rule was confirmed by the tax court in the 2014 Bob Rowe v. Commissioner case and took effect January 1st, 2015. Before that case, many people believed, including some financial advisors, that the 1 per year limit applied per account. It does not. It applies across all IRAs you own, including both traditional and Roth. Let me put a real number on this. A retired engineer had 3 separate IRAs at 3 separate institutions after a long career. In the span of 6 months, he moved money from all 3 accounts through indirect rollovers, receiving checks, depositing them at new institutions within 60 days each time, following what he thought were the rules. His first rollover was valid. The second and third were not. He received a tax bill for $180,000 in income he did not know he had. The combined value of the 2 disallowed rollovers in a year when he had already filed his return. The IRS could not waive this. His advisor could not fix it. There is no self-certification procedure, no private letter ruling, no second chance for this mistake. By law, the IRS has no authority to grant relief for violations of the once-per-year rule. It is the one IRA rule that is truly irreversible. Again, the fix is the same as mistake 3. Use direct, trustee-to-trustee transfers for every IRA movement. There is no once-per-year limit on direct transfers. You can transfer from any number of IRAs to any number of new institutions in the same day. If you want, no clock, no limit, no risk. The indirect rollover, the physical check, the 60-day window, the 1 per year rule, exists for a specific use case that most retirees never actually need. If you are consolidating accounts, switching institutions, or moving money to a better rate, use direct transfers every time. Here it is, the 5th mistake, the one I told you about at the start of this video. If you own a traditional IRA and you are 73 or older, or 75 if you were born in 1960 or later, the IRS requires you to take a minimum distribution every year. We covered the full RMD mechanics in the previous video, so I will keep the mechanics brief here. What I want to focus on is how new retirees miss this and what it actually costs when they do. The penalty for missing an RMD is 25% of the amount you failed to withdraw. 25%. Not on the tax. On the distribution itself. If your RMD for the year was $18,868 and you missed it entirely, the penalty is $4,717. Before income tax on the withdrawal, before interest, before any related underpayment penalties. Corrected within 2 years, the penalty drops to 10%. Still $1,887 on an $18,868 shortfall. And on a larger account, a $750,000 IRA at age 73 generates an RMD of roughly $28,302. A missed distribution carries a $7,075 penalty. That is a penalty on money you are going to have to pay tax on anyway. You are paying the penalty for nothing. But here is how new retirees actually miss this in the real world. Because it is almost never as obvious as simply forgetting. Scenario 1. The year you turn 73, you don't realize you are now subject to RMDs. Secure 2.0 changed the age from 72 to 73. Many people who turned 72 in recent years were told they did not have to take RMDs yet. And they did not. But then they turned 73 and nobody sent them a letter reminding them that the rules had changed and they were now required to take distributions. Their broker may have sent a notification buried in account statements. They may have missed it. First-year RMDs are the most commonly missed because the retiree is operating on the assumption that the rules that applied last year still apply. Scenario 2. You have multiple IRAs and you forget about one. RMDs can be aggregated across traditional IRAs, meaning you can take the total RMD amount from any one account, rather than proportionally from each. But you still have to calculate the RMD from every traditional IRA you own, total them, and make sure the combined amount is withdrawn. The IRA you opened at a bank 20 years ago that you rarely check. The rollover IRA from your first job that is sitting at a brokerage you have not logged into since 2018. These accounts still generate RMD requirements. The IRS does not know you forgot about them. It just sees that you failed to take the required distribution. Scenario 3. You take more than your RMD 1 year, thinking it carries over. It does not. Taking extra in 1 year does not reduce your requirement in the next. Each year's RMD is calculated independently based on your December 31st balance and your current age. You cannot prepay or bank RMD credit. Let me give you a real scenario. Patricia is 74. She has 2 traditional IRAs, one at her credit union with $180,000 and one at a brokerage she opened 25 years ago with $60,000. She knows about the credit union IRA and takes her RMD from it religiously every December. She has forgotten that the brokerage IRA exists. At age 74, the IRS factor is 25.5. The brokerage IRA generates an RMD of $60,000, 25.5 equals $2,353. She misses it. The penalty at 25% is $588. Not catastrophic on its own. But if she has missed it for several years without realizing it, those penalties compound. The missed amounts are still owed, and the IRS can assess penalties going back to when the RMDs first became required. If she had forgotten about this account since she was 73 and misses distributions for 2 years, she could be looking at penalties of more than $1,000 plus 2 years of missed taxable income that now arrives as a lump sum. The fix for mistake 5 is an inventory. Right now. Not after this video. Right now. Write down every tax-deferred retirement account you own. Every traditional IRA. Every rollover IRA. Every SEP IRA. Or simple IRA. Every old 401k. From a previous employer that you have not rolled over yet. Every single one. If you are 73 or older, every one of those accounts has an annual RMD requirement. Find the balance on December 31st of last year. Divide by your IRS life expectancy factor from the Uniform Lifetime Table. That is your required distribution. Make sure you have taken it by December 31st of this year. If you are under 73, make sure you know exactly when your first RMD is due. Based on your birth year, your starting age is either 73 or 75. Put it in your calendar, not the deadline, the year itself. The year you turn that age is the year you need to act. Before I close, let me give you a checklist you can run through in 5 minutes today. 1. Find out what your IRA withholding percentage is currently set to. Log into your brokerage account or call your custodian. If it says 10% and your tax rate is higher, change it immediately. 2. Calculate your provisional income, your adjusted gross income plus tax-exempt interest plus half your Social Security, and compare it to the thresholds for Social Security taxation. If you are near a tier boundary, large IRA withdrawals need to be timed carefully. 3. Check whether any IRA movement you are planning uses a check or direct transfer. If a check is involved, convert it to a direct trustee-to-trustee transfer. 4. If you have moved IRA money in the last 12 months through an indirect rollover, mark the date of that distribution. You cannot do another indirect rollover until 365 days after that date. 5. List every traditional IRA you own. Compare the total required distribution to what you have actually taken this year. If there is a shortfall, take the remaining amount before December 31st. If December has passed and you have a shortfall, file Form 5329 with your tax return and pay the reduced 10% penalty. Do not ignore it and hope the IRS does not notice. Let me bring it all together. The 5 mistakes new retirees make with their IRA, in order of how commonly they occur. Mistake 1. Accepting the 10% default withholding without checking whether it matches your actual tax bracket, and ending up with an unexpected April bill plus underpayment penalties. Mistake 2. Taking a large IRA withdrawal without first calculating the Social Security tax torpedo effect, paying an effective rate of 40% or more when a split across 2 years could have cut it in half. Mistake 3. Using an indirect rollover, receiving a physical check instead of a direct trustee-to-trustee transfer when moving an IRA, and missing the 60-day window or failing to replace withheld funds. Mistake 4. Doing more than one indirect IRA rollover in a 12-month period, not knowing that the once-per-year rule applies to all of your IRAs combined. A mistake the IRS cannot waive, and that has cost retirees hundreds of thousands of dollars. Mistake 5. Missing a required minimum distribution, either because you did not realize you were now required to take one because you forgot about an old account, or because you thought an extra withdrawal 1 year covered you the next. The penalty is 25% of the missed amount, drops to 10% if corrected within 2 years, and cannot be avoided by any waiver or excuse after the fact. The year you retire is when these mistakes happen most often. Not because retirees are careless, because the system stops managing things automatically and never explains what you are supposed to do instead. That gap is what this channel is for. If this video helped you, hit the like button right now. 1 second. It helps this reach retirees who need to see it before their first full year of distribution ends. If you are not subscribed, subscribe and turn on the bell. The next video in this series covers the IRA Medicare surcharge, the premium increase that can add $4,800 or more to your annual costs based on a financial decision you made 2 years ago that had nothing to do with Medicare. It is the most expensive IRS trap that nobody sees coming. You will not want to miss it. If you know someone who just retired and is taking their first IRA distributions this year, send them this video. The most expensive mistakes happen in the first year. Share this before it costs them. Drop a comment. Which of these 5 have you seen happen to someone you know? Have you made any of them yourself? I read every single one, and the most common situations become future videos. I will see you in the next one.